I want to break a couple different mortgage myths for you. A couple months ago, we heard LLPAs. The media took off with that. What that is loan level price adjustments. And why those are important is because that's how we actually determine the final interest rate per borrower based on maybe the down payment that they have, their credit score, the income that they make. Those loan level price adjustments are affected by all those things. And so what the media took off with and what everybody kind of went into a panic about was, why would lower credit borrowers get better interest rates than high credit borrowers? And it's simply not the truth. What happened is they basically just made it more of a level playing field. Do I agree with it? Not so much. However, it's what they did, right? And it's the reality of the situation. And so what happened, just to give you a very basic example, is let's say somebody had a 650 credit score and they were going to get offered a 7% interest rate. And then you have another borrower who has a 780 credit score, they would get offered a 6.5% interest rate. So there's a half a point difference. What the banks have done in the LLPA's adjustments that were made is they basically took the low borrower credit at 650, who was getting the 7% interest rate. Instead of giving them a 7%, they bumped it down to 6.75, about a quarter point difference. Now, on the flip side of that, the good borrower with good credit, who should be getting that 6.5% interest rate, they've now been bumped up to, let's say, 6.625, right? So they're still getting a better interest rate, but the gap is just closed down a lot more. So if you have any questions about this, you're thinking about buying, you hear these misconceptions, you want the facts, you want the truth, reach out. We'd love the opportunity to help.